Welcome. This entire presentation has been arranged and developed by the team of experts over at My Tax Accountant, one of the UK's leading accounting firms. Today we're diving into a powerful but often overlooked tool for business owners like you. We're talking about the Small Self-Administered Scheme, or SSAS. So let's jump right in.
So, let me start by asking you a question that probably sounds a bit wrong. Can your pension, the pot of money you're carefully saving for retirement, actually be used to help fund your business right now? I know, it goes against everything we're taught. But what if I told you there's a way to make your pension do double duty, working for both your future self and your company's growth today? Stay with me.
You know the feeling. You've had a good quarter, and there's some spare cash in the bank. The big question is, what do you do with it? Do you reinvest it in the business, maybe get that new bit of kit that would boost production, or do you salt it away into your pension, bringing that dream retirement a little bit closer? It always feels like an either-or choice, a real tug of war between the company's future and your own. Well, what if you didn't have to choose? That's what we're going to unpack. Here's a quick look at our roadmap. We've just touched on the dilemma. Next, we'll define what an SAS actually is. Then we get to the really exciting bit, the SAS superpowers. After that, we'll get into the important stuff, the rule book and the risks. And we'll finish up by helping you decide on your next strategic step. Let's get started.
All right, so let's pull back the curtain on the SSAS. First thing to know, this is not your typical run-of-the-mill pension scheme. You need to think of it less as just a retirement pot and more as a dynamic, strategic financial tool that's built specifically for business owners. Interested? You should be.
So, what is it exactly? A small self-administered scheme is an occupational pension set up by a limited company. The small part is key. It's for a maximum of 11 members. Think directors, key staff, even family members who work in the business. And here's the crucial part. Every member is also a trustee. That means you, not some fund manager in a skyscraper, are in the driver's seat, making the investment decisions together. It's like your own private investment club. Now, you've probably heard of a SIP, a self-invested personal pension. A lot of people get these two confused. A SIP is a solo act. It's a personal pension for an individual. A SAS, on the other hand, is a team effort, an occupational scheme for a company. And that difference leads to the one single feature that changes everything. A SAS can lend money back to the business that sponsors it. A SIP absolutely cannot. That right there is the game changer.
So here's a quick pro tip. How do you know if a SAS is a good fit for you? Well, if you're an owner of an SME or a director of a family-run business, you should be paying attention. If you're someone who wants more control over your pension pot and where it's invested, this is designed for you. And fundamentally, if you're looking for a smarter, more integrated way to plan for your business growth and your retirement, then you are exactly who this is for.
Okay, this is the part you've been waiting for. Let's talk about the SSS superpowers. This is where we break down the really unique advantages that can make a massive difference to your company's finances. This is how you put your pension to work long before you retire.
Superpower number one is the loan back. This is the big one. A SAS can lend up to half, that's 50%, of its net asset value directly to your business. Let's put that in perspective. If your SAS has, say, $400,000 in it, that's a potential $200,000 loan you could access. Think about what that kind of funding could do for your business right now. That's not a small amount of money. It's a serious injection of capital.
Now, it's not a free-for-all. HMRC has, as you can imagine, some very strict non-negotiable rules. First, the 50% limit is a hard ceiling. Second, the loan must be properly secured with a first legal charge on a quality asset. Third, the interest rate has to be commercial, at least 1% above the average bank base rate. Fourth, it has to be repaid in equal chunks of capital and interest over a maximum of 5 years. And finally, the whole thing needs to be documented in a formal, legally binding agreement.
But the loan back isn't the only trick up its sleeve. Superpower number two is the ability for your SSAS to buy your commercial property. Let me paint you a picture. Imagine Sarah, who runs a growing design agency in Shoreditch. For years, she was just pouring money down the drain paying rent. Then she set up a SAS, which bought her office building. Now her company pays rent, but it pays it to her own pension fund. It's an incredible loop. The business gets a tax-deductible expense, and a pension receives tax-free rental income. And when the property is eventually sold, zero capital gains tax. It's a brilliant strategy. And here's a little tidbit that makes that property buying superpower even more accessible. Did you know a SSAS can pool all the pension funds of its members together? So if there are 3 directors, each with £200,000 in their pots, you can combine that to create a £600,000 war chest. Suddenly, buying a significant commercial property goes from a distant dream to a very achievable reality. That's the power of the collective.
Okay, we've explored the amazing possibilities. Now, let's ground ourselves in the reality of the rulebook. I know rules and numbers can feel a bit dry, but getting this right is absolutely critical. So let's quickly run through the key figures for the 2025 to 26 tax year.
Let's quickly hit the 3 main numbers you need to know. First, your annual contribution allowance is £60,000. That's the max you can pop into your pension each tax year and get tax relief. Second is the tax-free lump sum allowance. This is the most you can take out as a tax-free lump sum when you start drawing a pension, and it's capped at £268,275. And finally, you have the lump sum and death benefit allowance, which stands at just over £1 million.
To make the loan repayment rule a bit clearer, let's look at this simple example. Imagine your SSAS loans the business $200,000. Over the 5-year term, let's say the total interest comes to $40,000. That means the total amount your business has to repay to the pension is $240,000. Because it must be paid in equal installments, that works out to an annual repayment of $48,000. Simple as that.
Now, here's a quick but really important note for your diary. Right now, the earliest you can typically access your pension funds is age 55. But please be aware this is changing. From the 6th of April 2028, that minimum pension age is rising to 57. It's a key detail to factor into any long-term planning.
All right, we've talked about the power and the potential. But to give you the full, honest picture, we have to talk about the other side of the coin, the risks and the very real responsibilities that come with the SSS. This part is crucial, so listen closely. When you join an SSAS, you're putting on a new hat, the trustee hat, and it carries significant legal weight. All investment decisions must be unanimous, which can be tricky if you and your partners disagree. You are all personally on the hook for the scheme's administration and making sure it complies with every single HMRC rule. And here's the tough one. You have a legal duty to act in the pension's best interest. If your business defaults on its loan, your duty as a trustee is to chase that debt, even if that means taking legal action against your own company. That's a serious conflict of interest you need to be prepared for.
And if you think you can bend those rules, let me be blunt, don't. The penalties from HMRC for getting it wrong are brutal. If they deem a payment to be unauthorized, it gets hit from all sides. There's a 40% charge on the individual, a 15% charge on the scheme, and potentially another 15% surcharge. You could end up losing up to 70% of the money in tax penalties alone. It's just not worth the risk.
Okay, after hearing about those penalties, you might be feeling a bit nervous. But here's the most important pro tip of the day. You don't have to do this alone. In fact, you shouldn't. Because of the sheer complexity, the vast majority of SSAS schemes appoint a professional trustee or a scheme administrator. They are the experts who handle the admin, keep you compliant, and make sure you stay on the right side of HMRC. It's a vital safeguard.
So, we have covered a lot of ground. We've seen the incredible potential, but also the serious responsibilities, which brings us to the final, crucial question that's now on the table. Is SSAS the right strategic move for you and your business?
Let's boil everything down to 5 key takeaways. 1. A SSAS is a uniquely powerful tool for blending your business and retirement goals. 2. Its main superpowers are the loan-back facility and the ability to own commercial property. 3. It gives you amazing control, but that control comes with heavy legal responsibilities. 4. The HMRC rulebook is strict, and the penalties for breaking the rules are severe. And 5, which is the most important point of all, getting expert financial and tax advice before you even think about starting is not just recommended, it's absolutely essential. And of course, before we finish, the official bit. Please remember that all the information in this presentation has been for general guidance and educational purposes only. It is not and should not be taken as financial advice. You should never make a major financial decision based on this information alone.
So, if any of this has sparked your interest and you think a SSAS might be right for you, what's your next step? The smart move is to talk to the experts who live and breathe this stuff. I highly recommend you reach out to the team at My Tax Accountant for personalized professional advice. Their details are right here on the screen. Give them a call on 0207 0531 or drop them an email. You can also read their full article on this very topic on their blog. And finally, don't forget to subscribe to their YouTube channel for more fantastic insights. Thanks so much for watching.